I remember just like it was yesterday, the day I lost $3,000 trying to trade futures contracts on the NASDAQ 100. I'm sitting in my little office. I'm looking at the small view of the Mediterranean Sea. Things should be perfect, right? But I am just stressed out. At least when you're at work and your job is going crappy, you still go home getting paid. Well, I was putting in lots of hours, lots of hard work, lots of stress, and I was losing money. I wasn't even taking a paycheck home. And I was thinking, what the hell am I doing? Like, this isn't what it was supposed to be like. The only thing I was gaining was gray hairs. But then I switched from day trading, trying to catch quick moves in the market action, to doing weekly and monthly options trades. And in today's show, I'm going to tell you, not secrets, because there are no secrets. I'm going to show you what I look for when I'm looking for a cash secured put, which is the #1 options play that I use on a weekly or monthly basis. Welcome to 15-Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. I'm your host, Nick Bradley. Let's get into it. So, you want to be an options trader. You want to learn the dirty, dark secrets of the options world. Well, the secret is there really isn't any secrets. But there is a lot of hard work and a few good strategies that you can mimic or you can look for and things you can pick up on. So let's talk about those today. Cash secured puts. First of all, this is not financial advice. These are just my strategies that I use for weekly success. But if you're interested in learning more, I think today's video is going to help you out. Before we talk about one specific trade, the cash secured put, let's talk about what is an option in general. An option is a way of controlling 100 shares of a company's stock without actually having to buy the stock. We're going to talk about Apple in a little bit. Apple's trading around $230 per share. So to have 100 shares of Apple, you need $23,000. But if you used an option to trade Apple, you could control 100 shares for maybe $4,000 or $5,000. So you get some of the benefit of the upside potential of Apple for way less money. And options give you that opportunity. It's a leveraged play on a stock. And I know if you listen to Dave Ramsey, he'll tell you leverage is bad. Well, not all leverage is bad. You just have to be careful when you're using leverage. So there's two types of options. There's a call option and a put option. Let's dig in and see which one's which. Looking at this chart here, a call option, you want to buy a call option if you anticipate the price of the stock is going to go up. Conversely, you want to buy a put option if you think the price of the stock is going to go down. You want to sell a call option. This is so confusing my wife, but try to take math and words out of place. These are just terms that the options traders use. You want to sell a call option if you anticipate the stock going down, or if you just want to get some premium. And then finally, you want to sell a put option if you anticipate the stock or the price going up. In selling a put is what I call, or what the industry calls, a cash secured put. And that's primarily what I'm doing on a weekly basis. Quick pop quiz. Let's see how familiar you are with cash secured puts. What is a cash secured put? Is it buying a stock on a discount? Is it obligating yourself to buy 100 shares of a stock? Is it getting paid to wait for a stock to fall to your certain price? Or is it D, all the above? And in fact, it is D, all the above. It is a way of buying a stock at a discount. It is, however, obligating yourself to buy 100 shares of the stock. So don't get into a cash secure put or really any options trade unless you're willing to buy 100 shares of that stock. And then it's also a way to get paid to wait for a stock to fall down to your desired price. And we'll talk about that here in a second. So you have to identify and manage market risks. And one of the big things in options is going to be volatility risk. A little volatility is good. Too much volatility, no bueno. Good volatility brings good premiums. However, bad volatility brings sleepless nights. Which brings me to the #1 rule that I have for myself. I am never going, I shouldn't say never because sometimes I break this rule. But the rule that I try to follow is I only trade cash secured puts on stocks that I'm willing to own for the long term. Warren Buffett says, do not get involved in a stock for 10 seconds that you're not willing to own for 10 years. And that is very true of a cash secured put or any options play. I only trade cash secured puts on stocks that I'm willing to own or want to own for the long term. Let's talk about example #1, Apple. Everybody knows Apple. Everybody loves Apple, probably. But let's say the current price of Apple is $231. Right now it's like $230. You want to own Apple around $220 per share. So you could sell a cash secure put at the 220 strike, and let's say you're going to get paid $42 for that. So you're getting paid $42 to wait to see if Apple's going to fall to 220. If Apple is above 220 at the expiration date, let's say it's 1 week out, if Apple is above 220, even by 1 penny, you keep the $42 and nothing happens. If Apple is below 220, even by 1 penny, you buy 100 shares of Apple. That's called being assigned to the stock. And then you can now do a covered call. But if Apple falls to 200, 180, 170, guess what? You still bought it at 220 because that was the predetermined price that you said you were willing to own Apple at. So cash secure put is a great way to wait for the stock to fall, but if it falls violently, you can get assigned. So make sure, rule number 1, only trade stocks you're willing to own long term. Let's look at example number 2. Super Micro Computer, ticker symbol SMCI. Current price around $45. Let's say you want to own it at $42. Hey, I like Super Micro, they're a good AI play, but $45, that seems a little steep. Let's see if I can save a little money. So you sell the 42 strike for, let's say, $76. If by Friday, when the option expires, or whenever you set the predetermined date for, if by Friday that determined price is above 42, you keep the $76. Hey, you made some money, and then you can refresh. That's what I do every Friday. I log in, I see what options are going to expire worthless. I close them out for maybe $1 or $2, and then I will sell another cash secure put. But if Supermicro is below $42 by the end of expiration date of that contract, then you're buying SMCI at 42, even if it's 40 or 39 or 30. You said you'd buy it at 42, so that person's going to hold you liable to buy it at 42, but you still keep the $76. So what happens if you get assigned? Well, you have to buy the 100 shares, but it's not over. The fun continues because now you're an owner of 100 shares of that stock that you said you'd be willing to buy, and now you do the wheel. And what is the wheel? Well, instead of the cash secure put side, you're now selling a covered call. SMCI, you bought 100 shares at 42. Let's say it fell to 40. So now you're only $2 off your strike price. So you did the cash secure put, you sold the put up here, then you got assigned. Now you can sell calls for more premium. If it goes up, let's say you sell a covered call at 44 and it goes from 40 to 44 in that next week, you'd probably make maybe $100 that week on the covered call side. Somebody else is then going to buy the shares from you at 44. You keep that money from the 44 and the money from the contract, and then you restart. You sell put, and then if you get assigned, you sell a call, stock gets called away, so on and so forth. The wheel continues. I will do a specific video on the wheel, how I do the wheel, and different types that I've actually done the wheel on. Right now, let's just stick to number 1, the first type, cash secured puts. Rule number 1, and then we'll dive into the charts. I only trade stocks that I'm willing to own or that I want to own, and you should too. So Apple, here we've got Apple trading right now live at $229.72. What do we see? These lines right here are called Bollinger Bands, and Bollinger Bands give you some sort of indication using standard deviation of where the price is going to go within a range of time. So right now we're up here towards the red Bollinger Band, which tells me Apple's been on a bit of a hot streak, and when it gets up a little higher, it's probably going to come back to life, at least to the middle, sometimes down below. So looking back here, we had the Bollinger Band up here, it bounced back to the bottom, went up to the top, kind of went to the middle, back up to the top, fell outside of the bottom, got to the middle. Trump tweets got us below the Bollinger Band. We kind of bounced around in the middle, and now we're back up to the top. So I actually wouldn't want to sell a cash secure put in Apple here because we're at the top of the Bollinger Bands. We're probably going to see some movement down in the near future. SMCI, okay, is the exact opposite. It's looking like it's at the bottom of the Bollinger Bands here. And it looks like it's been there for about 10 or 11 days. We also have this gap. And many times when you have a gap, it looks like a gap wants to get filled, whether it's to the downside or to the upside. This big gap between prices, something happened there, probably earnings. Yep, we got earnings right here. The earnings dropped the stock down, probably because they had some bad guidance, because they actually have good numbers. They're making good revenue. But when you're thinking, hey, things might slow down, the CEO might say 2026 is going to be slower for us, the stock can drop. I like the SMCI's trading at the bottom of the Bollinger Band because you've probably got some levels of support here. Right there. It's got an all-time high of, or not all-time high, but recent high of 65, and we have that box. So I actually like SMCI. It's probably got some support around 40. So let's look at SMCI. This is Thinkorswim, and you can use any broker you want. I'm just going to type in SMCI. Let's get to the option chain, and it's currently Tuesday, but let's look at what's going to happen next Friday. So 10 days out. I normally do 7 days, but if there's some good movement in the market, I might do a midweek trade. All right, where do we say SMCI might be heading? It might be heading down to this level of resistance, and you've got the Bollinger Bands. So let's say in the 30s, even 40. So right now it's trading at 43.68. And here at the 40, we could get paid $50 over the next 10 days. So you're willing to buy 100 shares of SMCI at $40 per share. So you're looking at a $4,000 all-in bid, and you're going to get paid $50. Wah, wah, wah. Actually, it's not bad. Let's look at the math on that. I'll pull out my trusty calculator. 50 bucks on a $4,000 risk, 0.0125. Now, 365, you do it 36 times, giving you a 45% return. So 50 bucks doesn't seem like a lot, but on this option, you're getting a 45% annual return. So 50 bucks over the next 10 days, is it going to change your life? No, but you're only trading $4,000, or you're only risking kind of $4,000. I've got some friends that own rental properties. I have a rental property. Let's say you could sell your rental property after fees, after taxes, you're going to walk away with $100,000. You could sell 25 options contracts at the 40 strike. So now 25 options contracts times 50 bucks, that's $1,250 a week. If you did that, well, it's over 10 days, so it's not really a week, it's over 10 days. So you did that 36 times. Now you're looking at $45,000 of potential profit in the year. Again, it's a little bit of a hyperbolic scenario, but if you're trying to compare, hey, I've got rental property, I've got some cash on the sidelines, I'm willing to go in every 7 or 10 days and make some trades. There is some really juicy premiums if you're looking for them. I want to talk about one more thing real quick in case you don't want to go into the charts, right? So like I looked a little bit, I drew a line, I can see where there's going to be some support. The Bollinger Bands are free on a thing like TradingView. You can draw a box, you can see where this gap is, right? But let's say you didn't want to do any of that. When I first started trading options, I would only use the delta. So again, I'm finding a stock that I like, and now I'm looking for a delta. And the delta is going to tell you basically the risk of you having to buy 100 shares of a stock. So the delta line is right here, and you can see they've got 0.07, 0.09, 0.1, 0.2. Think of this. We looked at the $40 strike, which pays 50 bucks right now. That is the 0.19 delta. So that means there's about a 19% chance over the next 10 days that you'll be assigned 100 shares of SMCI at $40. That also means there's about an 80% chance that you won't. Are you willing to try to earn $50 to possibly have to buy MicroStrategies at $4,000 with an 81% chance that you won't have to buy it and you'll just keep the 50 bucks? For me, I am. So I would engage, I would sell the covered call here. So you click on it, it's going to pull up. How many do you want to buy? Again, make sure these are 100 shares each. So if you only wanted to buy one at $4,000, you are selling, I said buy, but you're selling one contract for August 29th, 10 days out at the $40 strike. So if by close of business Friday at 4 p.m., Friday the 29th, if SMCI is even 1 penny above $40, you keep the 50 bucks and you can do it again then. So that is basically how I am selling cash secured puts on a weekly basis. I go in every Friday, sometimes Monday, depending on the volatility, and I look for stocks that I don't mind owning for the long term. Stocks that are giving me pretty decent premiums, like $50 again over those 10 days. That's a 45% return year on year average. And that's, well, it's good enough for me. Thanks for joining me today on 15 Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. I'm your host, Nick Bradley. We'll see you next week.